Good morning. Today is Tuesday, June 27th. The time right now in Singapore is 7:28 in the morning. Today, I want to spend a little bit of time to talk about the Japanese yen. We have known for a while that the Japanese yen has been falling largely because of the interest rates divergence between the Bank of Japan and the rest of the major central banks. Japan basically has still maintained its ultra-low interest rates at negative 0.1 relative to all other major central banks, especially after the last 2 weeks. We see most major central banks has continued to hike interest rates, with the Bank of England taking the market by surprise by hiking interest rate 50 basis points. So this is in a contrast as to the different monetary policy adopted by the Bank of Japan, because simply they cannot afford to hike interest rate, because the interest to service the mountains of national debt accumulated over the years is just impossible. It will blow up the national debt if they attempt to raise interest rates. So right now, Japan is caught between the devil and the deep blue sea. That what they do is that they can't afford to hike and they cannot afford not to hike. Okay, so right now we are seeing the market tearing the Japanese yen apart simply because of the interest rate differential, and that is causing a lot of capital flight away from Japan, and this is beginning to cause concern among government officials. Last night we have the Vice Minister of the Ministry of Finance coming out to actually comment on this issue, because it's increasing the cost of input for Japanese importers, exporter basically. And what they do is that they are looking to soften the blow of a weakening yen. And just because a key official has come out to make a comment, I think the risk of a intervention by the Bank of Japan has increased significantly. This week itself, we saw that the dollar basically has eased off a little bit, and the yen has strengthened a little bit, but not by very much. Last Friday, we saw the dollar versus the yen is trading just under 144 against the yen. So this is again the year high so far. So this is a beginning to raise some red flags in Japan. So what are the odds of an intervention? Nobody really knows, but it's becoming to be quite obvious that the officials here are beginning to send signals to the Bank of Japan to watch these rates here. So that means currency trader would have to watch out for a possibility of an intervention by the Bank of Japan. Now, when you look on this chart, this is a daily time frame chart. On the extreme peak here at 152, that was last October, and that was also when the Bank of Japan came in to intervene. So how do they intervene? They basically sell off US treasuries, take the dollar proceed, and basically sell the dollar to support the yen. So could they do the same thing again? Very, very possible, but we do not know for sure. But look at the price here. So as the market goes into 144, this is a bracket of price that will make this currency pair very vulnerable for a counter move, okay, so to say. So the area in which I'm more concerned is 142.5 to 146.65. So right now we are smack in between. So would it be a chart point in which we will have to be worried? I think we have to refer to the lower time frame to look at the structure. But by and large, this is an area that is becoming very, very risky to continue to buy dollar versus the yen. So do watch out for a reversal, whether it is going to be based on an intervention by the Bank of Japan or by other means. So what I'm trying to say is be careful. That's all I have for you for today. Okay, and I'll come back to you with another update tomorrow. Bye-bye.